Warren Buffett's 6 Rules of Investing. Warren Edward Buffett is an American business tycoon, philanthropist, and investor. He was born on August 30, 1930. Presently, he serves as the chairman and CEO of Berkshire Hathaway. He is among the most successful investors in the world, and as of October 2022, his net worth was over $95 billion, making him the 6th wealthiest person in the world. But how did he become so rich? Buffett was born in Omaha, Nebraska. He developed an interest in business and investment when he was young, eventually enrolling at the University of Pennsylvania's Wharton School in 1947 before transferring to the University of Nebraska at 19 and earning his degree there. He later earned his MBA from Columbia Business School. It was there that he developed his investment strategy based on the Benjamin Graham-initiated idea of value investing. He enrolled in the New York Institute of Finance to concentrate on his economics training, and soon after, he started working with Graham in several commercial ventures. In 1956, he founded Buffett Partnership Limited. His company then purchased the Berkshire Hathaway Textile Manufacturing Company, using its name to form a diversified holding company. In 1970, Buffett became the chairman and largest shareholder of the company and has remained so. He has been dubbed the Oracle or Sage of Omaha by the international press. Despite his enormous wealth, he is renowned for his austerity and dedication to value investment. Buffett is a charitable man. He promised to offer 99% of his wealth to charitable causes, principally through the Bill and Melinda Gates Foundation. With Bill Gates, he established the Giving Pledge in 2010, whereby millionaires promised to offer at least half of their wealth. Buffett is an expert investor who practices value investing. Value investing entails buying undervalued stocks and holding on to them over the long term. He and his business have been able to navigate through periods of inflation and economic downturns with remarkable ease thanks to their investment philosophies. In addition to the value investing theory, Buffett also has a set of guidelines for choosing the best businesses to invest in. Let's dissect these guidelines and examine how we might use them to guide our financial choices. Can you achieve success as an investor too? Well, here are 6 principles Buffett based his strategy on. Rule number 1, never lose money. Rule number 2, never forget rule number 1. For Buffett, this is the first and most crucial investment guideline. This rule has to do more about an investor's mentality than market movements. Even Warren Buffett can experience loss, so no one is immune to losses. He is always better at living cheaply, though. He has been in the same home since 1958 and always gets McDonald's in the morning. His frugal spending habits ought to serve as a model for anyone wishing to invest like him and for entrepreneurs generally. We must exercise caution when spending our money if we're to become wealthy and maintain it like Warren Buffett. Rule 3 is never invest in businesses you cannot understand. Buffett is wary of investing in ventures he doesn't fully comprehend. A good example is the cryptocurrency market. He is quoted saying, "I get in plenty of trouble with stuff I believe to be something about." He asks, "Why should I invest in something I don't understand by taking a long or short position?" Using this guideline, he advises investors to focus on protecting their investment by picking businesses and goods they are well versed in. While certain businesses or projects may appear to be very profitable, it is reckless to invest in it if you don't completely understand what they want to achieve. The next rule is be prepared to take the long road. Our favorite holding period is forever. Buffett has a track record of identifying well-rounded businesses and sticking with them for a long time. For example, Berkshire Hathaway has held on to its Coca-Cola investments for 34 years. After accounting for reinvested dividends, Coca-Cola's stock generated returns for Buffett's firm of 5,810%, demonstrating the enormous value of holding on to the stock. Buffett's success with this approach makes it understandable why he recommends others to follow suit. If you aren't willing to hold on to a stock for 10 years, he advises, don't even consider holding on to it for 10 minutes. Next rule is never invest borrowed money. Buffett strongly advises against entering the investment world if you don't have the necessary funds. He claims that risking all you have and need for something you don't need is foolish. There can be instances where you observe a stock performing so well that borrowing money to invest in it seems like the best course of action. It would be a benefit if you kept in mind that buying stocks always involves some risks. Even if a stock may be performing well right now, if you purchase it with borrowed funds, its value could plummet and leave you in debt. Furthermore, suppose you use borrowed funds to purchase stocks. In that case, your priority will be repaying the debt rather than developing a long-term plan to maximize returns, which contradicts the preceding guidelines. The sixth rule is, be fearful when others are greedy, and be greedy when others are fearful. Buffett's final advice is to steer clear of investing with the crowd. You must rely on your market knowledge to succeed as an investor. Buffett is attempting to convey that the price will rise if many investors have favorable opinions about a certain stock. You would overpay for such stock and not receive comparable returns if you bought it. This brings up the concept of value investing, which is choosing equities with a high intrinsic value but currently trading at a lower price. It is crucial to remember that you shouldn't try to stand out. Rather, follow your instincts instead of doing as the others are doing. The key lessons to extract from Warren Buffett's investment strategies are: 1. Invest solely in firms you fully comprehend. Warren Buffett has spent most of his career investing in companies he fully comprehends. Most investors in the 90s bet on IT because of its growth. He stayed away, nevertheless, believing technology to be too complicated for him to comprehend. 2. Invest time in as much reading as you can for fresh investment concepts. He encourages each investor to read every day because he is an avid reader. Reading can help investors learn about new trends and generate fresh concepts. 3. While diversification is beneficial, beware of going overboard with it. According to Buffett, risk reduction benefits from diversification only last so long. Investors don't always need to have a sizable stock portfolio. 4. Invest for the long term. He always responds, forever, when asked how long he believes a stock should be kept. Equities are never about the short term, but you don't have to take that literally to get the concept. 5. Like how you would approach a great furniture sale, handle stocks similarly, he claims. You look at the best deal while purchasing furniture. We don't mind paying more for a stock in a corporation when it is a stock. He advises pursuing a company at a discount if you believe it has value. So, what type of stocks does Warren Buffett own? Berkshire Hathaway's stock portfolio is made up of hundreds of billions of dollars in equity. Most of those were chosen by Buffett. Despite having around 45 different stock investments, only 4 stocks have made up nearly 70% of the entire value of the Berkshire portfolio. For more details on each of these top holdings, see Number 1 is Apple. By far, Berkshire Hathaway's largest stake in the stock of the tech behemoth, 5.5% of Apple shares, which as of late 2021 were valued at more than $150 billion, is owned by Berkshire. Buffett admires Apple not only for its sticky customers, difficult to think of a business with a more devoted clientele, but also for its pricing clout and excellent management. Number 2 is Coca-Cola. Berkshire is a significant shareholder in the beverage juggernaut, holding 9.3% of the company's equity at the time of writing, $22 billion. One of Buffett's best long-term investments has been his early accumulation of Coca-Cola shares, which he began doing in the late 1980s. Buffett is not only a loyal client, but also admires Coca-Cola's strong brand and extensive distribution system, both of which offer it a competitive edge over potential rivals. Then he has American Express. Berkshire controls 19.1% of American Express stock, or nearly $25 billion, making it one of the company's largest assets by percentage. American Express shares have been a component of Berkshire's portfolio for 30 years because of Buffett's appreciation of the company's powerful brand name and the fact that it serves as both a payment network and a lender in its operations. Another is Bank of America. Berkshire owns 12.6% of Bank of America's stock. The CEO of Bank of America, Brian Moynihan, and the rest of the bank's executives are greatly admired by Buffett. The company's stock frequently trades for an implied valuation that is lower than that of its big bank competitors compared to its assets' book value. Additionally, Bank of America has one of the greatest recent growth rates in its peer group, emphasizes share buybacks, and is a great dividend investment. Buffett has had a flawless career in the stock market, but that doesn't mean he hasn't occasionally suffered financial setbacks. It would help if you researched the stock you intend to invest in and used your best judgment when making purchases. Hopefully, you'll be on the road to succeeding as the world's next investing tycoon. To learn more about how market systems and the financial institutions work, subscribe to this channel and don't forget to give this video a thumbs up. It counts. Thanks for watching.